Welcome back to Cheddar News. Stocks closed, or the markets closed about 31 minutes ago, and they closed mostly lower on this Monday as President Biden there signed a bipartisan infrastructure bill into law. Joining us now is Doug Flynn, certified financial planner and co-founder of Flynn Zito Capital Management. Doug, want to get your take on the biggest takeaways from the market. As we noted, closed mostly flat, or mostly a lower, but really technically flat here. The Dow down just less than 0.1%, the Nasdaq less than 0.1%, and again the S&P flat.
Yes, I think this was muchly anticipated. So I think a lot of this was priced in already. So it's sort of like a non-event. It's just the news finally came through. So that's, I think, where we're at now. But, we turn to where do we go from here now? And that's the most important thing, because inflation is looming large, and that's the big question. And with all this spending, does that continue? That can put a damper on what people are spending as we move forward through this.
Morgan Stanley dished out some advice for 2022, essentially saying stay away from stocks and bonds, citing that it sees fading monetary support and high valuations holding back American assets. Do you agree with this assessment?
Well, if you look deep into what they're saying that Europe and Japan are better valuations than the U.S. I've been hearing that for about 15 years. So eventually that will be right, that there'll be an opportunity to make more on foreign investments than in the U.S. It's the longest stretch, admittedly, that I think in history the U.S. has outperformed the international market. So eventually it's going to turn. So eventually they'll be right. But I think if you look deeper, what they're saying is they're only calling for about a 6% drop in the U.S. Markets next year. And that's not a huge drop. So the headline is that, stay away. But in reality, what's 6%? And I think really when you dig deep, they're saying the reason is because the Fed will probably delay increasing rates. And what that means is that if we have inflation, the way that the Fed fights inflation is to raise interest rates. If they delay and they don't jump on it fast enough, you can absolutely see a sell-off in the market. And then we can have a discussion on whether or not that's a buying opportunity, but that's what they're saying. So do I agree in some respects? I do. In other respects, if you look at every time the market's been up 20% or more, like it's scheduled to be this year, the last 9 times in a row, the market's been positive, 9 in a row, and 16 of the last 19 times the market's been up more than 20%. It's positive the following year. So, we could have a very good year next year. And then typically those years, they outperform the norm. So it's sort of a mixed bag, and they're on record, which is great, because we'll see whether they had it right or not.
It's interesting because you mentioned one scenario there, possibly delaying an interest rate hike. What's the likelihood and probability of the opposite scenario, where there's concern of inflation kind of getting ahead of us and the Fed taking action and raising rates faster? What happens in that scenario?
Well, that's actually the proper scenario. The Fed tends to be wrong and tends to be late. So the more likely scenario is that's going to happen. In fact, if you look at the end of last year, the Fed, by its own admission, was predicting less than 2% inflation. Well, they got it wrong by like a factor of 3 times. So, are they going to be right this time? Likely not. And when they do adjust, they tend to be a little late to the game, because they really want to see, is it not transitory? Because we've been hearing that it's transitory. Yeah. And I've been saying, and many people have been saying that, it's not really that transitory when, oil's gone up as much as it has, 70% in the last year. It's unlikely that kind of increase is going to return next year, but it's likely to continue on. And so I don't know that they're going to get it right, and often they're delayed. But if they do increase rates, that is what helps things from getting overheated, because inflation is a problem. And the president can talk all he wants about how he's not raising taxes on the federal level for people that make less than $400,000 a year. Yeah. And while that's technically true, if all of your expenses and all of your costs and everything go up significantly, yes, it's not a tax increase, but you're paying more. In fact, the single biggest factor that's not in inflation is rent costs. And last year, rent costs were muted because of all the people that didn't have to pay because of COVID and the waiver of having to pay rents. And so the increase in rents was not built into inflation. Well, there's no longer those waivers anymore. So wait till next year when people see all their rent numbers go up and inflation really takes a hold. That's going to happen.
It's happening right now. Someone who had to get a second apartment because my fiance has to work outside the city. We went from the rent price a couple months ago was $1,700 to now $2,100 for the same one-bedroom apartment. That $400 increase, and that's kind of across the board in a lot of the markets that we've been checking in.
Yes, and that hasn't even worked its way into the actual CPI numbers. It's going to take a quarter or two for that to actually work in across the board. But you're right, you're seeing it.
Yeah, and you know, in that same vein here, obviously that scenario that we're talking about, it just seems more likely that that rate increase happens given just inflation kind of continuously being higher and higher than expected here. How much of that is priced into the market right now and how much isn't, and is there opportunity?
You know, I think it is priced in a little bit, and it's sort of in a holding pattern right now, if you will. I think, look, you've got the opportunity for next year and the year after that to have record increase in earnings, record earnings across the board in the S&P overall. But it's going to be, you have to pick your spots. You're not going to have everybody participate. And so you have to be a little more selective, I think, as you move forward through this. There's certain investments and certain firms that have pricing power in inflation environment and certain ones that don't. And so you have to do a little bit more digging there. But overall, I think that it's somewhat muted right now and built in, but you have to see who can continue to raise prices and still drive those earnings up. Because as you know, if you have record earnings, you will then translate that into, ultimately in the long term, record stock prices, because they go hand in hand. In the short term, anything can and will happen, but in the long run, there's a direct correlation to companies that do well, that manage well, that are good citizens, that are profitable, and continue to sell more stuff to more people. The more they do that, the more earnings they're going to have, and therefore the higher their stock is going to go. That's the whole point, long term.
Yeah. Speaking of a muted reaction like the muted one we essentially had today in the markets, we've got a big week of earnings on tap, mostly big retailers like Macy's and Walmart. How much is inflation playing a role in terms of this muted reaction we're seeing ahead of these earnings? Is there concern that consumers pulled back, even though I guess there is data in the last couple of weeks that shows that hasn't been the case, but are investors a little wary ahead of these earnings?
Yes, I think that, Walmart in particular has not participated as well as the other big box retailers. A lot of their stocks are up 40 to 50% or more. Macy's is up 175%, and Walmart's up about 1%. So Walmart's a good barometer to look at. When people have had some extra money, they've continued to spend. But as costs go up and they have no choice but to raise them if that's how it goes, we'll see if they begin to wane in their spending. And that's one of the things I'm actually looking at, absolutely, is to see what Walmart does and how well they handle the pricing increases and inflation, and whether or not that is a direct result on people shopping, especially if they don't have the income that they did have before, or they're starting to get squeezed in all these other areas. Something's got to give. And of course, you don't want to think, food is going to give, but other things will give. And so we'll have to look really deeply at Walmart. It's something I'm actually looking very closely at to see how it goes.
Really quickly before I let you go, we know that Lucid just reported earnings a few minutes ago after the bell. Want to get your thoughts on where should this company be slotted in someone's stock portfolio, given what we know so far. The company reporting that reservations rose to 13,000 in Q3, reflecting an order book of approximately $1.3 billion, and that number has actually since grown beyond to 17,000. The company still remains confident to have 20,000 units in 2022. We know that delivery started happening towards the end of October. That isn't necessarily reflected in this earnings report, which ended, I believe, the end of September. And the company noting, obviously, that it bolstered its balance sheet to close Q3 with approximately $4.8 billion in cash. In terms of what we know of the company right now, what it just reported, where should this company be slotted in someone's portfolio?
You have to think about the fact that they still have a chip problem like other manufacturers have in this space. And you're talking about a company that does not have any profits and does not have any earnings. So let's put that in perspective. Yeah. And in fact, they're probably not going to have those things until 2023 as far as profits, and revenue to speak of and earnings till 2025. And so They do have $5 billion in cash, and they're in a good position. And look, 13,000 units is good. It's a good start. Everyone's banking on this being the key competitor to Tesla. That will remain to be seen. But what you have to do is you have to keep this in perspective and say, you know, is this the one that makes it? If it does, you'll be well regarded and rewarded for that. I think the problem is whenever you buy something that doesn't have a positive earnings, it's speculative, and so therefore falls into this speculative category. And in that respect, you want to invest with your head and not over it. But therein lies the opportunity, and so that's the way we look at it. It's hard to get behind something that doesn't really have actual earnings yet. It's all on the hype and the hope. And 13,000 is actually below what they thought they'd have, but not all of that is their problem. But nevertheless, it is in the end their problem if they can't make it happen. So that's the way we would look at it, is keep it in the speculative category and invest accordingly. That's how we would do it.
Doug, we always appreciate your insight. Thank you so much for being here. As always, Doug Flynn, certified financial planner and co-founder of Flynn Zito Capital Management.